Welcome back to Golden Roll Radio. We're recording here on Wednesday just after the Fed announcement of a 0.75% interest rate rise. And we're watching the markets. So by the time you're listening to this, it'll be Thursday. Always a little awkward on Fed days, isn't it, Miles?
Yeah, it can be.
Yeah.
Maybe not so much for people who take Powell at his word. Definitely awkward for people who are trying to front run Fed announcements.
Sure.
So, okay, going into today's Fed announcement, the expectation, of course, was we're probably going to get another interest rate rise, but his comments are going to be dovish going forward, with the expectation that, yep, we're getting to the end of this. Maybe by next spring we'll be done. Even though the interest rates are going up, borrowing pricing is going up, with an expectation that that would cause the equities market, the housing market, anything that could be subject to margin or subject to borrowing, probably to continue to decline as it has been doing. But because the expectation, or dare I say hope, that he was going to be dovish on the back end of his statement, we actually have been seeing increases in assets across the board until about 12:31 today.
Mountain time.
Mountain time here in Colorado, where we're at. Until a couple minutes after Powell started talking and you found out that no, he's nowhere near done. In fact, he would really like to see inflation rates get back down to about 2%. He understands that inflation is a lagging indicator, so the decisions that he makes take time to present itself within the inflation rate. As the interest rates kind of work their way out to the general public, he's aware of the housing market going down, fully expects it to continue. He's aware of the equities market going down, fully expects it to continue, and isn't ashamed to be the guy that forces it to do so. So with a hawkish actual statement following dovish expectations, obviously we've seen a pretty significant market turnaround following the statement. But I just find that interesting. Nobody even cares about the actual math anymore. It's just how do I think he's going to make me feel? That's how we're choosing to invest today. So our listeners obviously don't. You guys are smarter than that.
Yeah, I think a lot of our listeners do pay attention to a number of things that to make them smarter than the rest of the general public. And let's jump to markets. What are markets doing here right after the announcement? We saw gold. Let's start there. Gold pushed all the way almost up to 1670. And is down from that intraday high, down around 1630, 35, about a $35 swing in one day. But gold is still holding so far above the September low and the double bottom. Does it hold there? Well, I think my feeling here is that before the end of the year, you have a potential for a little bit lower move in gold. Potential. Not saying that it's going to happen, but I think that would be my timeline, is before the end of the year, you've got a low potentially being carved out. Maybe if this double bottom were to hold, maybe we don't see a little bit lower low before gold finishes the low. But I think we're awful close to forming a bottom in gold. Sure feels that way. And one of the things that is making us feel that way is that the price of silver has outperformed gold over the last couple of months. Since first part of September, here we are, first part of November, and that gold-silver ratio peaked at around 95, and now we're sitting around 85. So to see silver leading gold, at least in the short 2 months that we've been watching it, that's an indication that we may be close to a turn. What we would want to see is for gold to confirm some of that action there and to start following silver into a little bit stronger place.
Yeah, I completely agree. I mean, some of the levels I'm looking at on gold, first and foremost, one of the pillars of my rule set when I'm looking at charts is that the trend always continues until it doesn't. So you always assume a trend will continue until it proves to be a new trend. And thus far, like you're saying, we haven't really gotten that proof yet that we're continuing the long-term bull market trend in gold, that we're still in this short-term reversal correction period in gold, which thus far has remained relatively shallow. we're talking gold going down on the down end. Like I was saying, some of the levels I'm looking at here on the bottom, maybe 1560, 1570 on gold. That puts us in our short-term 618 fib, which would be a very healthy short-term correction level. That also lines up with the longer-term 50% retracement. So that would be your legitimate 2 steps forward, 1 step back. And we're kind of right above that now at this point anyway. On the top end, there's a couple pricing levels gold would have to get above. I think first and foremost is the old market bottom from last year would be around 1685, 1687. And then obviously we'd have to put in a higher high, which the last high we had was around 17 and a quarter. Now, I like the correlation with silver because silver has actually done that. Silver, like gold, has found a very similar pattern where we put in what kind of looks like a double bottom. Now, in between that double bottom, silver has actually put in a slightly higher high as well. So could we just be building a little shelf here that we continue the downward spiral in silver? Sure, why not? That's fine. But we also could be looking at some reversal tendencies here as well. And coming into the end of the year, it's pretty expected November, December tend to be relatively flat or down months for gold, for other metals. And then we tend to get a pretty decent spike back up in pricing around January, February, March. It was March of this year that we put in the highest price ever in gold. So it wouldn't be surprising to me if we do see gold and silver lag here throughout maybe the end of the year, and then picking up in January, February, March, we start to see us pushing against some of those previous highs.
And speaking of other metals, I want to talk a little bit about platinum, not only because I like platinum, I like where it is and think it's a good value, but I had a couple calls from some listeners asking if we would cover platinum a little bit more.
Me too. I was actually just about to say that. Yeah. I've had a couple clients call and be like, you guys haven't talked about platinum in months.
And we haven't. I mean, we have over the last couple years because, well, measure platinum against gold, and platinum was about half the price of gold, which is about as far down relative to gold as it's ever has been. And platinum is a lot rarer than gold. So here we are. Platinum is not half the price of gold. Platinum is pushing just a little bit away from the half price of gold, and has actually been in an uptrend since September 1st. And so it may be subtle, but platinum's acting pretty strong here. And I have also noted from a couple articles I've seen on the inventories of platinum have been declining in the COMEX. So there must be some buying going on in platinum, not only the price action just slowly creeping higher and in a nice little trend line since September, but the inventories are showing that there's metals, actual physical metals being sucked out of the COMEX.
Yeah, well, where does the inventory come from? At least a very large percentage of it comes from a little-known country on the eastern side of Europe called Russia.
Yeah, they're not covered in the news very much lately.
No, not these days. And Russia might have a couple sanctions sitting on top of it. In fact, something that is being covered in the news, because it is a more pressing concern, obviously, is oil and natural gas availability coming out of Russia into Europe, in the fear that we have a significantly dangerous winter this year, with Russia's oil supply dwindling down to, I think, about 20% of normal production capabilities. In fact, the IMF just put out a report that I'm going to mention here later in the show, talking about their expectations and forecasts for the next year. And a lot of it does hinge on Russia. Well, guess what? There's only so many stockpiles out there. So yes, I understand that as global economies slow, global production slows. So say the usage of raw materials goes down as well. But when you lose availability to get produced, ready to go raw materials like, say, platinum, because you have sanctions on a particular country that produces a significant portion of the global supply, eventually your stockpiles run out. So platinum isn't something we've been ignoring because we don't think it's interesting. It's something we haven't been talking about every week because at this point it's kind of a no-brainer that you absolutely should have some in your portfolio. And I know that's been a part of a lot of our conversations with clients who are building out their gold portfolios. Platinum remains a necessary piece, and it's very possible, like you said, we're a few bucks away on the platinum price from a pretty legitimate breakout. I mean, we're talking about getting back above the July highs around right where we're at now, 940, 950. Then all of a sudden you're over 1,000. Then you're at 11 or 1,200. And now we're back into some early 2021 pricing.
Yeah, and since you had a couple calls on it too, I'll just go ahead and say, if you're listening right now and have a question or have a comment or want us to cover something, call us. Let's talk about it. Something else that I've had calls on is people wanted me to talk about premiums on physical metals.
Right.
Because that's been a big deal.
Yeah. And we have talked about that a fair bit over the last couple months. I will admit that we have not done our job on platinum, but I will say we have tried to comment about the premiums in the coin and bar market because it's been kind of crazy. You and I have both been here going on 20 years now. I've never seen anything like this before.
It's true. And specifically silver. Gold premiums are actually pretty low. I'd say platinum premiums are pretty low. But silver, take your pick of the product, and it could be plus or minus $10 or $11, $12 between.
Yeah, not percent, dollars.
Dollars, which, I mean, that's what, 40 or 50% of the price of silver. So, on the high end, on the bullion market, you have Silver Eagles. Those are at stupid high premiums. And then all the way down to your COMEX deliverable bars, 1,000-ounce bars. That's the most efficient way to get into silver, but you've got to buy 1,000 ounces, 20,000 roughly dollars, well, a little bit more than 20,000 per lot. And it's not like you're going to be able to sell parts of it. Plus, it's not for delivery, really. You don't want to take it out of the COMEX. So your most efficient purchase in silver being very common brand name 100-ounce silver bars. That'd be the largest size you'd probably want to take possession of. They're still pushing 23 plus, almost $24 per ounce, and the price of silver and spot price is sitting just above 19. You've got a premium. This isn't the first time we've seen things like that, especially in the history of the company. You have times where the physical market just does not follow that spot market, that contract market where it's not physical metals being bought at 19, 20 bucks. You have your physical market that is just holding and saying, if you want real silver, if you want the real material, then here's the price. And I think going forward, if things continue to unravel the way they are in the world, I think we will continue to see premiums like that develop, not only here with silver for the last couple of years, but I would say in gold and platinum. It's possible that you have a completely diverged market for physical deliverable metals versus whatever the paper market's doing.
Yeah, it's always amazing to me when you see that disconnect between what actually exists and then what exists on paper in a leveraged or marginable position, and what is good delivery and what is completely illiquid outside of the confines of the system that it works within. And you're absolutely right. It's the difference between contracts and deliverable product. We're seeing it in the silver market. We're starting to see it in the gold market. We are starting to see premiums start to inch up. Not much. Don't panic. Don't panic. It's not silver, but we are starting to see it a few percentage points here and there in the gold market. And I think based on our previous conversation about platinum and Russian availability and sanctions and what's going on in Europe, I think we could start seeing it in some of the other metals as well, as we see kind of tightening of the belts in various countries and maybe slow down of production at certain mines. I know a number of mining companies aren't doing great this year. That's declining share and declining capital available to put back into mine production when your stock goes from 85 to 39 in 6 months, not naming any names, but there can be some problems there where it's affecting production and capability and inventory. What also is amazing to me about all this is that the average consumer understands this. Like, I haven't had a single phone call from a single person saying, what do you mean Silver Eagles are 35 bucks?
Right.
I have had a few calls saying, what do you mean your Silver Eagles are only 35 bucks? And I say, yeah, we might be the cheapest in the industry, but I still don't want to sell them to you. Let's go look at these bar prices. So if you're sitting on a significant Silver Eagle position, that may be worth reaching out to your ICA broker about too, because there may be somewhere you can pick up some free ounces. Just a thought.
Yep. He's referencing cutely what we've been doing over the last few months with, I think about 3, maybe even 4 different physical products. 2 Eagles, actually, I guess all U.S. made coins. And just a hint on gold premiums picking up, and I have noticed that the gold Eagle premiums have actually jumped quite a bit. So that might be the first sign that there may be some more premiums developing to the high side with gold. But we've been doing exchanges, or you could call them swaps, however you want to phrase it, where we're selling one product and within the same metal buying another product and netting ounces. So, I mean, I think some of our clients have netted 50% in ounces on the Silver Eagle trade that we've been doing. There are a few other products that have that type of premium. Some of the old silver dollars are at high premiums. So there are things that we're doing, even though it feels like this metals market might be just sitting here boring, watching paint dry, trying to find a bottom, blah, blah, blah. We're making some trades with various products that are actually increasing ounces for clients fairly significantly, which allows them more ounces in their portfolio so that when the prices do move higher, they've got even more upside.
So finally, trying to keep an optimistic beat in relatively pessimistic expectations. I mentioned the IMF recently put a report out expecting 2023 to be quite a bit harder than 2022 for most people. There are concerns in Europe right now. Natural gas costs are up 4-fold for them since last year. Concerns over availability and heating expenses for this year. Very genuine. And a severe disconnect between the real market and what the system says it's worth that we're seeing coming out of the Chicago exchange or out of the New York exchange. So there is logic underneath all of this. I think you really can look at the markets and kind of chuckle and say, well, of course, that's what happened today. Of course, the stock market went up in anticipation of Powell speaking and then immediately shot back down. Of course, we're moving into seasonal times where commodities are going to do what they always do, but the volatility is getting bigger. So, and within volatility, we are doing what we can to try to find some of those things like you were just talking about. Like, where do we find the opportunity buried within what feels like a crisis? Because it does exist out there. So I second you on the idea that if you haven't reached out to your broker at ICA recently to talk about your portfolio, maybe not a bad idea. We're coming up on the end of the year, and just take a look at how things have progressed this year and maybe lay out a plan for next year. So not a bad time to reach out and touch base.
That does it for Gold and Oil Radio this week. Thank you for listening. You can follow us on Twitter at ICA Gold, like us on Facebook, McIlvanney Financial, our website, McIlvanney.com, and give us a call, 800-525-9556. Thanks for listening. Have a great week.